Welcome to Chapter 18 of the Wealth Management Essentials course. In this chapter, we're going to be looking at asset allocation. So it is a build off of the asset allocation that we discussed in the previous chapter. The learning objectives include the asset allocation process, issues in asset allocation, the strategic asset allocation or SAA, rebalancing, and tactical asset allocation. So we're going to start with the asset allocation process. The first step is determining the strategic asset allocation. So the SAA should be designed to help clients achieve their long-term objectives in a way that is consistent with their risk profile and constraints. Once established, it becomes a benchmark against which the performance of the client's portfolio can be measured. Step number 2 is rebalance the portfolio. So as the portfolio grows over time, it will drift from the SAA. And for this reason, the portfolio should be periodically rebalanced to maintain the desired asset mix. Step 3 is to formulate a tactical asset allocation strategy. This is optional, so not everyone needs to use a tactical allocation strategy, but sometimes it can be used. And the main purpose is to take advantage of opportunities created by anticipated short-term fluctuations in the performance of different asset classes. So if it is a time period where the fund manager thinks that the market isn't going to do well within the next year, maybe they move more money towards bonds. If they think the market is undervalued and is going to have a great year, maybe they overweight equities. Now, there are some benefits to asset allocation. One is that you focus on a critical source of return variability. So the asset allocation affects the variability of returns and the long-term risk and return. Also, an efficient investment portfolio. So the goal of an SAA is to find an efficient combination of asset classes that will achieve the client's return and risk objectives, and then you can try and build a portfolio upon the efficient frontier, which we discussed in the last chapter. Meaningful performance measurement. So a clear SAA makes it easier to set goals and measure progress against those goals. It also allows you to compare against similarly weighted benchmark portfolios of money market, bond, and stock indexes. Investment discipline. So it ensures that the portfolio continues to reflect the original SAA and the client's long-term investment objectives. It also helps advisors and clients decide whether to add new asset classes or securities to the portfolio. Tactical flexibility to enhance returns. So if a client is willing to take a bit more risk while trying to achieve a higher return, they could slightly deviate from the SAA when opportunities arise, otherwise known as that tactical asset allocation. Now, there are also a few different issues with asset allocation. One is just the classification of assets. So assets, they can be assigned to various classes. And even within a class of assets like debt securities, there are various different debt securities with different levels of volatility and risk. So debt securities, they can be segmented based on term to maturity. So it could be short, medium, or long term, credit quality, structure, geography. Also equity securities, they can also be segmented based on capitalization, geography, and style. So for example, if you have a strategic asset allocation of 70% equities, usually small caps are a fair bit more volatile than large cap stocks. And so you could be taking on a different level of risk if you have more small caps, but they are still considered equities. So sometimes those specific calculations, they are missed when looking at a strategic asset allocation. The second issue is selection of asset classes. So clients with a longer time horizon and a larger appetite for risk will generally have more equity, whereas clients with a shorter time horizon and less willingness for risk will generally have more fixed income and guaranteed investments, which just don't grow as well over the long term. Location of asset classes. So debt securities and guaranteed investments which generate interest income should be held in registered accounts such as an RSP and TFSA, If it is inside of a non-registered, then that interest income is fully taxable. Equity securities, which generate capital gains and dividends, should be held in a taxable account if you do have one. So basically, if you have a lot of different registered investments and a non-registered account, it is better to overweight or put more of the equities in that taxable account because it is just more tax efficient. The other issue is costs of rebalancing and trading. So rebalancing and trading costs, including commission or trading fees, those can be quite costly. Capital gains in non-registered accounts and some less visible costs, such as market impact costs, are a factor as well. So sometimes if you do have a non-registered account and you have this strategic asset allocation, well, it might be good to rebalance some of that equity portion to more bonds and cash. But one, you might be triggering a fair amount of capital gains, and then the client might have to pay taxes on that. And you're just moving it into maybe a safer investment that is now paying interest income, which is less tax efficient. So there are some different issues with just asset allocation in general. Usually it is a pretty good idea to do it. I mean, you should do it, but there are some other factors to keep in mind when you are creating a portfolio. So next we'll look at determining the strategic asset allocation. So you will have to look at investment objectives. So you can sometimes use questionnaires to evaluate a client's return objective, risk profile, and time horizon. Some clients may be unrealistic by wanting high returns and no risk. The risk/return trade-off may need to be explained to the client. There's also capital market expectations. So they represent the expected annual return, standard deviation, and correlation of each asset class over a specified investment horizon. Next is designing an appropriate SAA. So mean variance optimization, basically it's a procedure to identify the efficient frontier from a set of asset class returns, standard deviations, and correlations. A pure mean variance optimized portfolio requires information on capital market expectations and a numerical value for client's risk profile to recommend a single asset allocation that is both efficient and acceptable given the client's risk profile. There are some rules of thumb and time diversification. So this revolves around the principle of time diversification. It can be less risky to allocate a large portion of an investor's portfolio to equities if they have a long time horizon. So that is sort of just that other perspective to risk. You also have the life cycle approach which categorizes clients in different life cycles based on their age. And the age approach is just a general rule of thumb that suggests an asset allocation to debt and cash equivalents is equal to the client's age. So if a client is 50 years old, they should have 50% fixed income, 50% equity. The ad hoc approach, so it is not recommended, but it is sometimes used. So this is when the asset allocation is based on the advisor's opinion or instincts. Now, when rebalancing, sometimes advisors may just do calendar rebalancing, which involves regular rebalancing either monthly, quarterly, semi-annually, or annually. The drawback to this is that it is a bit rigid. There's also weight-balanced rebalancing, so the advisor might adjust the portfolio whenever an asset class deviates from its target by a certain percentage point. The range can be determined based on transaction costs, risk profile, correlation with other asset classes, and volatility. And finally, just a little more information about the tactical asset allocation approach. So there are some different ways to approach it. One is valuation based. So this is when you identify inexpensive or expensive asset classes and maybe you invest into those inexpensive ones, the ones that maybe have low price to book ratios or price to earnings ratios, and you hope to buy them when the market doesn't appreciate them and sell them later when they are at their true value. So this just exploits the mispricing of asset classes and short-term anomalies, and it may incorporate analysis of risk premiums. There's also the approach of just a cyclical based approach. It involves monitoring the economic and business cycles and looking for patterns that have historically led to rises and falls in the stock and bond market. So you would mainly look at the yield curve, monetary and fiscal policy, etc. So if you look back at the year 2021, we had inflation going up quite a bit. Interest rates were still historically low. And so some people, if they use that cyclical approach, they could have looked at the fact that inflation was rising and interest rates were really low, and they could have maybe predicted a bit that interest rates had to go up to counteract inflation. And so that obviously hurts bonds, so that might be a reason to move out of bonds, maybe move to cash. Equities are usually hurt when interest rates go up as well, more so the technology companies, because they're not earning as much, mainly because they are companies that are more so projected to grow and have future earnings, and those are discounted more when interest rates are higher. So just based on that scenario, someone using a cyclical approach may have moved out of bonds into cash, which would have been a good decision, and maybe moved from more of those technology companies to more defensive stocks, which would have been a good move in 2022 as well. So sometimes there are these cyclical approaches that sometimes work, sometimes the investor gets it wrong, but it can help and sometimes help and try to earn a bit more return. And so those are all the main points in Chapter 18. I hope you found the chapter review helpful, and I will see you all in Chapter 19.